Hello, welcome everyone, and thank you for joining us for another great educational webinar we have here at Advanta IRA. And today we're going to talk about the world and the rise of private credit and private lending. I had a great guest speaker today who's going to talk about that area, give a lot and show a lot of his expertise in that field, and show you kind of how different ways you can invest in private lending through a retirement account, which is obviously what we specialize here in at Advanta IRA. My name is Scott Maurer. I'm the Vice President of Sales here at Advanta IRA. I will be your host during the presentation today. I'm a licensed attorney by degree. I don't give any legal work or legal advice for any Advanta clients, but that is my educational background. Maybe gives me a little bit better understanding at times of some of the issues that we deal with within self-directed retirement accounts and the different investments that our people and clients like to use their funds towards. My contact information is here on this slide. If you have any questions that you'd like to reach out to me in regards to your IRA, an old 401k, some different investment strategies that you might want to pursue with an account, always more than happy to jump on a call, jump on a Zoom meeting, whatnot, to go over those with you and get your questions answered. And as it pertains to today's webinar, if you do have any questions, either for myself or for our guest, please get those typed into the question box in your GoToWebinar control panel. We will make sure to get those addressed. Usually we don't, we'll put the questions in as we go along. Always happy just to interrupt our speaker, and if something's kind of topical that you're asking a question about, and get those questions answered. If you're not familiar with Advanta IRA, we are a self-directed IRA administrator. We help facilitate individuals who help assist them if they want to use their retirement funds to invest into real estate and private loans and precious metals, things like that. We've been around for over 20 years. And this is the only thing that we do at our business. It's really the administration of those accounts. We currently have over $3 billion in assets under administration. And we also have one-on-one customer service experience for people who use our firm, the clients, even the referral partners, and people who send us their clients and their investors. We look to put you with one point of contact or 2 points of contact here at Advanta IRA, so you get that dedicated kind of concierge level service for your account and for your retirement. So that's a little bit about what we do at Advanta. Some of the things we don't do is we don't provide investment advice. We don't endorse any products. So we're not allowed to sit down with you and advise you from a legal or a tax, and certainly not an investment perspective. The information we put out there, just like the webinar we're doing today, is from an educational perspective. We do like to make people aware of different investment types, different strategies, bring industry experts on like we've done today, so that you can kind of be exposed to other investments, but you do need to do your due diligence when making any type of an investment or working with any specific providers. Again, for those of you who are unfamiliar with self-directed IRAs, very quickly what they are: these are accounts, retirement accounts that give you, as the account owner, complete control over their funds into your account and the investing decisions. You're not being forced into one class of investment, like you're not being forced into mutual funds or stocks or anything that's publicly traded. Self-directed IRAs allow you to use your retirement funds to invest outside of the stock market into assets that are not tied to what the Dow Jones Industrial Average is doing on a day-to-day basis. As we sit here in April of 2025, we're seeing the stock market on a certain roller coaster every day. And so individuals who are looking to self-direct are looking to at least take a portion of their portfolio and get it into something that's more stable, maybe something that they understand that they can control a bit more. People typically choose to invest, and we're talking today about private loans and why people would use their IRA accounts. Why use your retirement funds to invest into private loans and lending vehicles? And I think for a lot of clients, it's kind of 3 different reasons. One, for some, it's just a new source of capital. I actually spoke with an individual this morning who was looking at doing some private lending in his account. He already invests personally into private loans and private notes, simply wants to do more of that, and he has funds in his IRA, he has funds in his old 401k that will allow him to then take on additional investments into that same asset class. So for some people, it's I would like to invest in more of a particular asset, or I'd like to make an investment, and the cash that I have that I can use is sitting in my IRA, is sitting kind of in my old 401k. For others, as I've touched on already, it's the stock market fatigue, the ups and downs of the market. People might have been losing sleep over the last few days or few months or years or what have you, with their money all invested in the stock market, wondering about what the next turn is going to be in the global markets. Getting your funds out of those typical markets into things that you can control, into alternative assets, at least make you sleep a little bit better at night, really truly diversify your account. And for others, there's the tax benefits. The income from this investments come back into your IRA, either tax deferred or tax free, depending on the type of an account that you have. So if you're in a higher income bracket now, and you use your IRA to make this type of investment, those loan payments, the dividends that you're getting back from those investments are just going back into your IRA, no tax consequence to you. So you're growing your retirement account, boosting it, you got it out of the market, and you don't have to worry about the tax implications as your IRA makes those types of investments. What types of accounts can invest in these different private loans and vehicles? Really any type of IRA, traditionals or Roths, or if you've inherited an IRA, you can certainly use an inherited IRA as well. Again, whatever portion you wish. You do not have to, this is not an all or nothing strategy. You can move over just a portion of, say, your Roth IRA from another custodian over into an account with us, and then direct us to make these private loan investments. If you're a small business owner, you may have a solo 401k or have a SEP or a simple IRA that allows you to make those investments. And as I said, the other big bucket of money that people forget that they have are these old former employer plans, old 401ks, old 403bs, old TSP plans. When you leave an employer and you're changing jobs, you're taking on a new role, you're taking on a new company, maybe you're even moving, a lot of people then forget that they have those old employer plans. They're just kind of sitting out there. That money, when you're with a former employer, can also be rolled over into a self-directed IRA and in turn used for these types of investments. Now, before I bring on my speaker, our speaker here in just a few moments, kind of what are the different ways that people invest in private loans with an IRA? As we've been on any of our other webinars, you know that we cover a lot of different types of investments. We even do a special webinar on just private lending with your IRA, but come with some of the different ways that the IRA funds are utilized. With loans, it's, the form can be of a mortgage loan, your IRA lending to an end user who's giving you a mortgage on their particular asset. So it's a real estate backed loan that you're making from your IRA. You're acting just as a bank would in lending money to somebody with that collateral. People invest in tax liens, which is kind of almost a form of lending to your local government and purchasing a property tax lien. You can do unsecured notes. You don't have to have collateral. There's no requirement from an IRS perspective that you need to collateralize your note. It may be a great idea to secure your note in certain circumstances, or maybe even in most circumstances, but it is not a requirement. There are debenture notes, option contracts. People put together joint venture agreements where your IRA is bringing the capital to that particular deal alongside another partner. And we've also seen individuals invest into like private lending funds, which are more like private placements where you're not out there as the IRA owner finding each individual loan to make. You're placing your money into a private fund, and that fund manager is utilizing your capital alongside other investors' capital to make those different particular loans that are out there. So that's a little bit just on the IRA side. With the private loans, again, we do a whole host of other webinars and a full hour-long webinar just on this topic alone within an IRA. You can go to our YouTube page and find those recordings, those links, or again, certainly reach out to me with any questions. But guessing the reason why most of you are here is to hear our speaker talk. So I want to make sure I give him ample opportunity to go through his slides, share his great information with you today. We have Samir Patel, who is the managing partner of Trophy Point Investment Group. He's the owner of multiple classes of real estate. He's a teacher at Georgia State University on real estate entrepreneurship, and he's an Army officer and West Point grad. His contact information is here on this slide, but I'm going to allow him now to share his information. I'm sure all his contact information will be there as well. So Samir, I'm going to turn the slide presentation over to you, and while you're pulling that up, again, just reminding those of you who are listening to us live today, if you have any questions, either for myself on the IRA side, for Samir on what he's going to be covering here when it comes to private credit and lending, get those questions typed into your question box. I'll make sure I get those asked to Samir before the hour is over. But Samir, at this point, again, thank you for coming on today, sharing your expertise. I'm going to turn it over to you and let you take it from here.
Thank you so much, Scott. I really appreciate it. And I'll start off by saying, I know Advanta doesn't endorse any sort of particular investment or firm, but I think I can safely say we endorse Advanta. Our fund is kind of large now. We have about 90 million across 200 plus investors and a lot of IRA, self-directed IRA investors. And I think I've worked with about 20 custodians in the last 4 or 5 years. And we, Advanta doesn't pay us. We don't pay Advanta or anything like that. But we do appreciate the way Advanta does business from a customer service perspective, because it is kind of a challenge sometimes moving from, let's say, a Fidelity to a custodian if you've never done it before, and that can take a lot of back and forth. But we appreciate Advanta and the way Scott and Scott's team does it, and we freely recommend Advanta for all of our investors that come our way.
Thank you, Samir. I really appreciate that. Thank you. Appreciate the words. Like you said, there's no financial relationship between us at all. Like, we don't pay you guys, you don't pay us. So we just said it's a mutually beneficial relationship.
Yeah, and I just want to make that clear at the beginning, but we do appreciate your team, Scott, and thanks for having me here. Like Scott said, like, I love real estate. I've lived it and breathed it my entire adult life. I bought my first hotel when I was a cadet, actually, at West Point, and I've just started buying and adding to my holdings pretty much ever since, over the last 15, 17 years, actually. And so going through a lot of deals as an owner, as a lender, and and as a borrower myself of private money, I think I've seen the whole spectrum of what could happen, and what you want to avoid. And I take all those lessons now into Trophy Point, and what we do. But I love teaching, and I love helping people. And Mike Martin has a quote down there at the bottom, like, he approached me about buying a small apartment deal and borrowing from us at some point, actually. And I asked him some very pointed questions about the deal. He went back, did some further due diligence, and found out that the seller was actually misleading him on the deal itself. And Mike would have probably spent a lot of money trying to fix it had he bought it after the fact. And I would say my philosophy is all about not losing money versus making money. The name of the game when it comes to building wealth is compounding. As most of you, I hopefully understand that concept of compounding your wealth over time. And the key to that is not losing, actually, versus sometimes the rate of return that you get. A loss, especially in a retirement focused account, could be detrimental to the overall wealth over 10, 20, 30-year period of which you're trying to compound your hard-earned retirement dollars. So that's our philosophy. Many private lenders share that same philosophy. I'm not sure if I'm unique in that way of thinking, but it is important to understand that about us and the way I'm gonna present my remarks today. So I'm from Atlanta, been in the Army. I was active duty for 6 years, Iraq, Afghanistan deployments, platoon leaders. I was a combat leader. I'm a cavalry officer by trade. And then I also had an entrepreneurial journey, where I wouldn't say dabbled. I was definitely involved in many businesses, lost a lot of money, made a lot of money. But it all served me really well today, where Trophy Point has actually now 90 million as of this morning, and how we manage the fund. And the majority of my wealth is actually now tied up in the credit fund that we own or run, because I think private lending and the growth of it is the best way for me to just grow my wealth safely and responsibly. And I'm in the Army Reserves too, which serving is a big part of who I am. But over the last 3 years alone, we've lent out 200 million, and we've gotten paid back 100 million. And any lender that tells you only about the originations is missing half the story, because any idiot can send money out the door. It's the getting paid back. That's the art. And so when you evaluate any sort of fund or lender that you're getting involved in, don't just focus on originations. Really, it's what have you been paid back, and how quickly have you been paid back on those loans, because that's the true strength of the underwriting. That's the true strength of how good that lender is or that fund is in terms of protecting your wealth. The second question I'd ask is, how many repeat or distinct borrowers do you have? You don't want an overly concentrated fund. You want to invest in something where they've got, quite a bit of diversity amongst their borrowers. And you also kind of want to see if their borrowers come back to them, because Trophy Point, we're not a 20% type of fund. We don't like charge our borrowers crazy rates, approaching usurious rates. That's not us. We are in the business of sustainably keeping our lending fund going and working with good borrowers, but we want them to come back. So I just offer these tidbits, as you consider, this world. Hopefully it's not new. Trophy Point's always raising money. I don't want to talk too much about what we do. I want to make this more educational, but we have standard investments of IRA versus non-IRA. Standard is non-IRA. It's a simple interest. We pay it back quarterly, the interest that is. And we also have an IRA option, which you should probably use Advanta if you need a custodian. And we're open to all sorts of accounts as well. One thing I'll say about me is that I have $8 million of my own money tied into this business, and I take the first loss on any bad decision I make. And I think that makes us stand apart from any other fund. I'm not aware of any other sponsor of a private lending fund that has so much invested and is willing to take it on the chin completely and lose all of his money before the investors do. So risk alignment is pretty important. So I want to take one step back here and discuss, I think my slides may have sort of jostled actually. So let me just take one step back about the business model of private lending. For those of you that are not familiar on this webinar, private lending is like a bank in many ways. We as a fund, we take money from you investors, or you could call us depositors in a loose sense. We take your money, we give you or promise an expectation of return. We're usually 8 to 10%. I would be very suspect of funds that offer 12, 15% type of returns. They do exist, but the risk profile that they take is different and higher. So you got to know that. But we take investor money and then we lend it out, typically at a higher rate in excess of the expectation that I gave you. So, investors basically give us 8 to 10% money at 8 to 10%, and then we take it out, we lend it out at 12, 13, 14, 15%. That is the business of private lending. And what all of us should do, most of us do, is that we take security or collateral in what we lend on. And this is where the risk reducing strategy, this is where this slide probably comes into play, is that we do various things to make sure that the loan is safe. The number one thing is we lend at a percentage of the value of the collateral. We don't lend at 100% of the value of the collateral. We lend typically up to 70% of the value. So there's a healthy margin of safety built in the worst case scenario. And that may be the other takeaway for you, is asking your lender or asking your fund manager, what is their worst case scenario? How do they think about the worst case scenario, right? Which is ultimately not getting paid back. What do they do when they don't get that interest payment, or the borrower has missed the maturity date? Well, 9 times out of 10, the worst case strategy is we're going to foreclose on that house or that collateral. And you don't want to, and if you have to foreclose on collateral and then liquidate it or sell it to get our money back for the fund, well, to fire sale it or to liquidate it, often you don't get 100% of the value because there's a time frame involved in that. And so that being said, we have 70% LTV, and most lenders probably stick to that. Some are 65, some are 85. And that up or down on the LTV also guarantees, or not guarantees, but indicates what type of risk that fund is taking on. Anything more than 70%, you're getting into higher risk stuff, in which they should be charging more. But we're entering a period of volatility, so I would caution you to think very hard about the types of assets and at what exposure rate they're getting into. And I think 70% is a good medium as of today. The other key thing is that you want to lend in states with a favorable foreclosure law or set of foreclosure laws. Some states like Florida, not a knock on Florida necessarily, but Florida is a judicial foreclosure state. That makes it hard because I have to go in front of a judge, basically prove that the debt is owed to me or to the fund. And the borrower has certain rights that they could use to force or delays, basically. So it's not uncommon in Florida for sometimes foreclosures to take 2 years, and time is money in this business, right? So could a lender sustain 2 years of not getting interest payments while they fight this foreclosure? That's not a palatable option. So we kind of avoid states with non-favorable foreclosure laws. California and Nevada are 2 other ones that we, well, definitely California, maybe not Nevada, but definitely we avoid California, definitely we avoid Florida. We sometimes avoid New York. New York is very nuanced. New York is very pro-consumer in one sense, but also very pro-business in another. And there's a distinction between business purpose loans and consumer loans. For the avoidance of doubt, Trophy Point only does business purpose loans, but we have to be very careful with the states that we do it in. But relatively speaking, the Southeast United States, great. Typically, Republican states or conservative states have pro-business, pro-lending type laws, which matters to us because we want to get our house back quickly if something goes wrong. And then you got other stuff like where is the portfolio, what's the average loan size? You want to just check for those sorts of things to make sure that we're not lending too much money on one particular borrower or one particular deal because we don't want the whole fund affected by that. And so, that being said, Trophy Point's average loan is no loan is more than 3% of our entire portfolio. So, and our average loan size is $250,000. So we have 300 plus loans, right now across the country. And managing 300 loans, I'm only as good as my team, as you can see here on this org chart. And we're the type of fund, and you should always ask this, is what do you source in-house and what do you source out of house? In my case, in Trophy Point's case, I do everything in-house actually, because I do it that way for customer service reasons. We can close loan in 5 to 10 days. And that means I have my own in-house escrow, I have my in-house title processor, I have my own in-house lawyer. I have a lot of things in-house that allow me to react really quickly and capitalize on deals. And so if you're a person borrowing money or wants to borrow money for a flip or something like that, and you're on this call, the question you want to ask is, how good is your team? If you could give me a quick indication of what your team looks like and what is your process for closing? Because any lender on the face of it verbally can promise we can close 5 to 10 days. That's a lot easier said than done. It really requires a whole back end operation to make sure it's done quickly, correctly, accurately, and done on time. And you want, people to call and talk to when something happens. Because if you're trying to flip a house and you're a cash buyer of a distressed property or a property not in good shape, a ton of questions just naturally arise out of that transaction. And you want a lending partner that has the ability and the capacity to manage all of it. Because that's why you're paying an extra premium. For those of you not familiar, people pay higher rates of interest and fees to lenders like us because we're closing very quickly. And that they're willing to pay that higher fee in order to secure deals quickly, because good deals in this market will not last long at all. There's a lot of cash buyers out there. There's a lot of lenders like myself out there ready to pounce. But this is what the back end looks like to make it all happen.
Samir, I did have a quick question coming as you get into the meat of the presentation here. Someone asked, do you provide ground up construction loans? And I guess you probably get into more about what types of loans and the different, private credit and whatnot. But just curious, that was an initial question that came in. Wanted to make sure I asked it, and certainly encourage anyone else to put their questions in as we go along.
Yeah, I love it. I love questions. So feel free to type it in the chat. Scott, feel free to bother me or interrupt me. I love questions. Yeah. So the short answer is we do ground up. The longer answer is it involves your experience in doing so. Like, we don't really fund first timers when it comes to ground up because there's so many moving parts to that. But we do it for folks that have demonstrated track record and the ability to do it. So if you're not familiar, private credit and lending has blown up significantly over the last 5 years, and maybe even over the last 15 years since the great financial crisis. And I'd love to give you a quick history lesson on that. And I bring up this little cartoon here because I feel like the guy that just walks up to you at the urinal and whispering in your ear that we're in the golden age of private credit. Like, I feel like that guy to the uninitiated. But I am that guy. I will be that guy that does that, because even if it's awkward, because I think private credit represents the best way to compound your wealth in a risk-adjusted manner. And I feel very passionately about it. So, Howard Marks, he runs Oaktree, a very well-known hedge fund. Basically what he's saying is now investors can get the same type of equity-like returns that you've experienced over the last 4, 5, 10 years from private credit instruments, debt instruments, than you can from equities. And in many ways, it's safer and there's less volatility. Like, over the last week, I think everyone, if you paid attention, you've got an education in what volatility looks like as a result of monetary and fiscal policies from whatever administration that is in power, I guess. Whereas private credit, like, we're not volatile. We're earning a straight flat rate return, double-digit returns in many cases, and we're secured. And so I think what Howard Marks is saying here is that it's amazing now that we've entered this golden age where you can get the same sort of returns, double-digit returns potentially, with a lot more safety and less volatility. So I'm not going to read every parts of this, but back in the day, when I mean back in the day, I mean the 80s, 70s, 80s, 90s, banks were the name of the game. But due to regulation in the 90s, banks became less prevalent, and the availability of capital was declining from public sources, which is banks. And banks also started focusing on larger companies. So the day of going to a bank, typically to get seed capital to open up an ice cream store on Main Street, that might have worked in the 50s and 60s and was a great way. I mean, it was an amazing way how America built its infrastructure. That no longer happens. I think you'd be laughed out of a bank today if you were trying to go open up an ice cream store from scratch. You may get it. Some community banks may do it, but typically banks want to focus on companies that are larger, that have 5 million plus in revenue to begin with. And what's fulfilled this need for capital is private credit. People like me, mom and pop folks like myself, that just pull money from myself and my family and friends, and we make these loans. And that's actually how I got started in this business. In 2008, I just graduated from West Point, and the financial crisis was in full swing. Banks were not lending. Liquidity had pretty much all but dried up. And I was in Atlanta, maybe even ground zero of failed banks actually in the country. And a family friend wanted to buy a liquor store, like a $250,000 transaction at the time, and he needed about 200 grand to do the deal. So he approached my father, who's a friend of my father, and he approached me, my dad, and 6 other guys. We cobbled together 200 grand to make our first ever loan at 15% on a 2-year term. And we trusted the person, we trusted the liquor store business. It's not a hard business to understand. The guy was coming in with $50,000 of his own money. The business itself had revenues, and there was land attached to the deal as well. It seemed safe for all those reasons, and we did it. That was my first loan ever. And then another person asked, and another person asked, and another person asked. And that story has played out elsewhere throughout the country, is that the banks pretty much stopped servicing lower middle market America or lower market America in terms of private capital on real estate and smaller businesses. And private capital has filled the void in that. And private debt funds have grown dramatically, especially over the last couple of years as well, as people have realized that, hey, I can get the same amount of returns, but safer and with less ups and downs that I would get in the stock market. And so this may be my favorite sort of chart describing this over this trend I'm talking about. Like in the 1980s, we almost had 15,000 banks, and now we only have a third of that as of today. Whereas private lending, has its up and downs as well. It's not a perfect industry, but since 2022, like, there's been some monumental shifts regulation-wise, and you've kind of seen it in some of the headlines with the failure of even some banks. I wouldn't say gangbusters, but we have definitely become more popular in what we offer. And that's not a bad thing. I mean, in one sense it is, because it's more competition for people like me as a fund manager. But in the other sense, it's also great because that means there's more capital and more acceptance from the general investing population of what we do, which is maybe even more important, because that's why I've grown from $0 in 2020 to 90 million in assets 5 years later. We may be the fastest growing private lending firm from scratch, actually, that's non-institutionally backed in the country. But for my purposes, it's good to see that we're becoming more accepted in mainstream. We're no longer the hairy-chested, gold chain, gold ring type of moniker or stereotype that some people look at or think of when they think of private lending or hard money lending. We are sophisticated. We have teams. We have software that supports what we do, especially. Like, we have all the same sophistication, I think, that banks probably enjoyed in the past.
Samir, if I can ask you a question on that kind of chart there, what do you think would be any reasons why you would see maybe a rise of commercial banks coming back into play, or do you think that's something that's somewhat it's been either consolidated to an extent, or what they were doing in industry is simply being done better by folks like yourself in the private lending space? Is there a reason why we might see an increase in commercial banks? Do you think that's kind of here to stay?
So I think that's a wonderful question, because it is an existential threat actually to private lending funds. The reason why we exist is because the banks cannot lend. And the reason why the banks cannot lend is a couple of reasons, mostly regulation. So, as the current president has proven, at least in terms of like the act, I could easily see an administration one day potentially lifting the regulations on banks. And it could be done with a stroke of a pen, theoretically. Now, that being said, it can happen where the regulations could be lifted and the controls on banks could be lifted, because it is somewhat artificial in the reasoning for all that. But the likelihood, I think, is less, because I think, especially in 2008, I think the federal government, which kind of backstops all of this, they want safer bets. I don't think they want banks just slinging loans like they might have used to in the 80s and 70s, because it's kind of understood and maybe even accepted mainstream that the banking sector is too big to fail in general, because it's always backstopped by the US government and the FDIC. I think the government doesn't want too many banks, actually. And I think the government actually likes this, I would say. They want less banks that are doing better deals, essentially. And we're on the private lending side, we are taking a lot of unknown risks. Now, I think they're sensible risks, but they are still like, risks. Most private lending funds default rates are in the 3 to 4% range. And a lot of commercial banks, they would get shut down by the FDIC if they go beyond 3%. So I hope that answers your question. I think it can happen, but I don't think it's going to actually happen, probability-wise.
Yeah, no, great answer. Like I said, encourage people to continue asking questions like that as we go through it, presentation.
Yeah. So let's go. So real quick, what is and what it's not? I think I've already said this. Private credit is usually a debt instrument, and it has a promissory note. It has guarantees. It's secured, meaning there's a lien. The interest rate is stated. The return is predictable, as it should be, because it's a loan. And really, it's highly dependent on legal and contract knowledge, actually. It's very legal-esque. That's why we have our own in-house lawyer in my particular fund. It's not preferred equity, even though it could look like it, and it's not for everyone. I think lending requires specific knowledge of the industry, because every industry is different. Like, I don't lend on warehouses. I don't lend on medical office. I don't lend on office, God forbid. I don't lend on any of those assets because I've never owned them, and I need to know what to do with those assets in a worst case scenario. I mean, if you gave me a medical office building, yeah, I know leasing it up would be the first thing to do, but I wouldn't know how to manage it. So you want a sponsor that knows what they're doing inside the industry, and not get involved with a sponsor that has loans in many, many different industries, unless they have like a bunch of analysts and infrastructure backing that up. So just don't think that you're making a loan and it doesn't matter what you're doing with that loan. It does matter how that money is being deployed in the loan. And the best part is that we're not regulated as much. The only regulation we do have is in some states you have to have a license, which is not a barrier. We are regulated in terms of like interest rates that we can charge, but we're not regulated in terms of our book. Like there's no SEC, there's no FDIC equivalent coming in examining our books for that reason. Now, many firms are audited to prove their balance sheet and prove their returns, in which I'm audited, but that's not a form of regulation. That audit is something we do voluntarily for the sake of trust of our investors. If you're curious, Tiger 21 is a group of high net worth individuals, and every year they publish where their members, high net worth individuals, allocate money, and they kind of have in a third, or a fourth, depending on how you want to interpret this. Private equity is a quarter of it, real estate is a quarter of it, and public stocks are another quarter of it. Plus, then you get some of other smaller ones down there. But we're in the real estate bucket, and we're probably in the private equity bucket in some ways too, because we're all private, and real estate typically is private as well. So high net worth individuals typically do have allocation to funds like ourselves, and I think it's only going to increase actually as people get away from public equities. I kind of said this already, like, lending is great. Higher returns relative to equities without the volatility, less risk. You can diversify your money a lot better over loans. It's predictable. You got security, assuming you take security. And in some ways, it's an inflation hedge, right? Because you can set your interest rates floating based on some sort of index known as, like, so for example, we used to use SOFR, which has replaced LIBOR. You could tie it to prime rate. There's many indexes that you can tie your interest rate to. We at Trophy Point, we do it fixed, but our loans are 6 months, right? So after 6 months, I can increase my rate with inflation, or I may decrease it depending on other market factors. So there's ways you can get and stay in tune with inflation with lending as well. And you want to ask your private lender how they do it. I would be very wary of a private fund that offers 5-year payment terms. Good private lenders shouldn't do more than a year, more than 2 years at the very most. Because if inflation, let's say, spikes to 12%, just for argument's sake, and your loan is only a 10% loan that you've made interest-wise, then you're losing 2% in purchasing power. Whereas what I'd rather do is make it a year-long loan or a 6-month loan, and if I still have that loan going for whatever reason, I can always reprice the loan to stay in tune with market conditions to make sure that we're not really losing money. So what to look for? I may be summarizing here, but you want someone that knows, that has a process and has discipline. They're tight on what they'll lend on. They're tight on what they won't lend on. They have a process to continually do these, and they can maintain quality control over that process. They have the speed and ability to get deals done quickly, because that's how we generate the return, is that we offer speed in lieu of rate. Customer service matters a lot. Like, I tell my team that we get paid to listen, actually, from the borrower client perspective. Our clients have special deals, and these deals mean a lot to them because they've got their own earnest money tied up into it. They've got their own down payment money tied up into it. They also have pursuit costs because they're also the ones sending out postcards and text messages to get these deals through the door. They have costs that they have on a monthly basis. So they're investing actually quite a lot. They're not just like borrowing 100% and then letting the deal ride. They have a lot of pre-baked in expense getting to the closing table in the first place. And they want to deal with a lender that respects that. And I respect it because I lived that life myself. And customer service is a big part of what we do. It's not just the finance. And like I said, because it's not just about the finance, it's not about the rates. We do not lend on a race to the bottom. We do not lend just to get deals through the door. Because we offer good customer service, it kind of gives us a niche where people are willing to pay a higher rate because they know they're going to get a great experience with us. They know we always deliver. We've never actually missed a closing if it wasn't our fault. Title usually pushes back closings. That's not in our control. Or the lawyer that does the research is not in our control. And so, like, these things all feed into how we do stuff. And the last thing is you got to trust your sponsor to make decisions, in which case it would be me in this case, because these deals come fast, and a good sponsor or a good leader, GP, whatever you want to call it, managing partner, CEO, if you want to call them that, they've got to make decisions quickly. And I've seen a lot of deals fall through because the sponsor needs to go back to their equity partners or their investors and ask for permission or ask them to look over stuff. And I don't think you actually want that. I think you want an empowered partner to actually make these deals in the first place. I could be wrong. You could, if you have a high need for information, then you should look for sponsors that give you that. But just know that if that's the process, then you're going to be on the phone probably every day or every week, and there's going to be an expectation that you quickly help provide your input so deals can get done quickly. I'm not going to go through all of it, but you should probably take a screenshot of it. I thought I'd just give you a couple questions to ask your private credit fund manager if you ever think about investing in one. But the one I'll call out here is, how do you influence the exit of the borrowers? And what I'll say here is, your loan is only as good as your exit. So I could lend $1 million on a golden bathtub, right? I could have it secured by this golden bathtub. It's tangible, I can see it, it's gold, so it's worth something at least at the onset of the loan. But if I can't sell this golden bathtub, even though $1 million worth of gold went into it, if I can't sell this golden bathtub in a reasonable amount of time, which in real estate, it's 3 to 6 months is a reasonable amount of time to sell something, is that loan really worth anything? If I can't sell it, I mean, even though gold has money value, but nobody wants this golden bathtub, and I know I'm being extreme in my analogy here, but I'm trying to prove a point. If nobody wants to pay $1 million for this bathtub that just happens to be made of gold, it's not worth $1 million actually. And so you got to ask, like, what is your private credit fund manager going to do once they get hold of the asset? So what I can do with a golden bathtub or what I can do with a house could be radically different than what another fund manager does, even though the loan could look the same. You want to know how your fund manager is going to ultimately be able to manage this asset to get your money back at the end of the day. So it's like you want to ask them, kind of like the second question or third question down is, you want to ask them, how have you foreclosed? How have you gotten our money back? What is your experience doing that? And frankly, like, I've been in this business for 15 years. Like, I find myself a semi-lawyer in the sense that I'm telling my lawyers now what to do and how to do it in order to get our money back. Do not rely on an answer from someone that says, oh, we just hand this off to our lawyer and our lawyer handles it. Yeah, lawyers matter, but at the end of the day, I'm still responsible. The fund manager is still responsible for the liquidation and disposition of the asset and the management of the asset. And the fund manager needs to know what to do. I could rent it out. I could fix it up and flip it myself. I could sell the loan to somebody. I could sell the house to a wholesaler. Like, I've got all these tools at my disposal, which is what we do. And I can actually affect those things on all of those spectrums because I've done all of those things. And you want to have a capable fund manager that can also do that as well. So real quick, if you're trying to borrow money or you're trying to like understand what's earned in a deal, this is what this chart explains. So fees are come in various forms, right? And you can negotiate, if you're a borrower, you can negotiate across all these things actually. And if you don't want, so origination fee, that is the fee charged at the beginning. And largely it's determined by the risk of the deal. So right now, our industry charges 2 to 4% upfront on the loan. So if we're lending out $100,000, the lender automatically gets 2%, $2,000 upfront in the form of a fee. And if you're a investor in the fund, you want to ask, what happens to the fees? Is it rolled into my profit, as in your profit that's shared, or is it something that the sponsor solely keeps but gives you more interest? In my fund, it's sort of all blended actually. So like we don't make really a distinction between the interest and the fees. Like it's all just income that goes into the fund, and that income is used to pay our investors plus ourselves. But some fund managers parse out the fees to themselves, and there's some risk. There's some incentivized risk that may not be aligned in that structure. You have to ask. The term, typically in our industry, 6 and 12 and 24 months are the terms. For real estate deals, I rarely go above 12 months. Most lenders also don't go beyond 12, but if you're willing to pay higher origination fees, or you're willing to pay higher interest, or you're willing to do something on extensions, then yeah, there could be a business case for making it a longer loan. Extension fees are a big part of this business, so this is really for the borrowers on the call. If you can get away with it, you may want to negotiate your extension fees ahead of time, because when you're trying to flip a house or you're trying to change an asset, things can go wrong, and it may take longer than you anticipate. And I'll say this, it'll definitely always take longer than you think. If a contractor tells you 60 days to fix something, you want to make it really 90 days. Very rarely has a contract ever done anything on time. Things always just take longer than you might expect. And then there's also additional fees, right? And that's usually loan closing costs. So usually, like, we use an outside attorney, in conjunction with our attorney to close loans in the various states that we're in. And so there's additional fees, settlement fees, typically done at closing that cover all those costs to actually close the loan. It's not origination. So that's that's really not a profit center in many cases, but it is still a fee that is used to cover costs and things like that, or filing fees and things like that. And then there's also obviously interest, which is 10 to 13% typically in our space. It could be higher. If the borrower doesn't want to pay any origination, then we'll say, okay, we'll be a 15% return with 1 point or no points. It is a negotiated sort of thing. But at the end of the day, if you're looking at investing in a fund, like I said, you just want to understand the totality of where this money goes and what's available for profit distribution and what's not. And you'll get to understand your fund manager a whole lot better too, because you want their risk and the money that they make tied in directly proportion to your risk and the money that you're going to get. So that's why I believe in combining everything, and then parsing out. But there are fund managers that say the points belong to them and the interest only belongs to you. And so what goes into a loan decision, right? The first thing is, are we going to be secured? You got to be secured. I'm not a fan of unsecured loans. There are lenders out there that will do it, and they're going to get 20% rates on it. But the risk level of unsecured goes up dramatically when you're not in a first lien or first position. You want to look at the collateral, like what's the plan to fix it up? Where's it located? Is it reasonable? Is it clear? Do you want to get involved in a lender that does extensive rehabs? Like, we don't typically fund full gut jobs unless the borrower is experienced. We will do ground up, again, if the borrower is experienced. But if it's a first timer trying to do a $300,000 rehab, that's not a loan we're going to do. The experience of the borrower, the financial capability of the borrower, all that stuff matters. If you're on this call looking to borrow money, what you want to show your lender is your experience. Like, hey, I've done 3 houses or 3 deals in the last 12 months. This is how they've turned out. This is my schedule of real estate owned. And you're prepared. You can clearly prepare. You clearly show preparation. You can clearly show you've got a track record of deals you've done in the past and deals you currently own and the current state of all of them. Neatly prepared. Usually it's a spreadsheet, but neatly prepared to just send any lender that information. And then your liquidity is probably the most important one. Like, do you have cash in the bank? We at Trophy Point do care if you have at least 3 months of expenses in the bank, because it just shows that you're prepared. Like, you're going to have unknowns when you do this type of activity as a lender, as a borrower, and your liquidity matters a great deal in terms of safety. Your credit score does matter, actually. Some lenders don't care about it. Some do. We are a lender that does, because we want to know, can you be bankable at the exit? So what happens in many cases is you buy a house as a borrower for 100 grand, thinking you're going to put 25K into fixing it up and you're going to sell it for 175, 200K. That's a great deal on the surface, right? But then let's say you get into it and you realize, oh man, I missed a specific repair and now I got to replace the whole roof. That adds another 10 grand of expense. Oh man, I missed something. Everybody missed it, but it turns out like part of the floor in the kitchen needs to be replaced due to an unknown water leak. These things will happen. And now your $25,000 rehab budget may turn into a $150,000 rehab budget. And we may hit a patch in the economy because of somebody or some event. And now you can't sell your real estate at the 200K level and it's only worth 175. So now you've got this compression sort of situation where, and your loan is due obviously with me too, right? Because it was a 6-month loan or 7-month loan. Well, your credit score matters because instead of flipping the house, you may decide, look, maybe it's better to turn into a rental and get it refinanced with a traditional bank. So that, and if you have a great credit score, and Trophy Point typically lends at 650 or above, we really do not deal with anyone below 650, and our average is actually 700. And we charge less if your credit score is actually better, because we like safer people. In our case, that's the way we do it. But we know our borrowers can refinance out of our loan if they needed to in a worst case scenario, even though they want to turn into a flip. But if they had to go into a refinance situation with a bank, their credit score matters a lot to the bank. And so we also underwrite them in the manner that a bank potentially would on the exit. And that's like another way I control the exit, right? Like we talked about a few slides ago, is the lender good at managing exits of the loan? like, yeah, I think we are, because we look at so many other things in a very detailed and process-oriented manner to make sure that our borrowers don't hurt us on the back end. And then, non-judicial foreclosure state, that matters. I told you about that, the laws. We focus on Georgia, Texas, in the Southeast. In those instances, I don't have to go in front of a judge to prove the debt is owed to me. I can just immediately issue a notice of sale and take it to the courthouse steps. And that's where I deploy my lawyer if we have those types of situations. But it hasn't happened that much. Out of the 1,000 loans that we've done, we've only foreclosed on about 12 properties so far, which we're very proud of. And then the other thing I look at is, sorry, Scott, did you have a question?
Yeah, I did. Well, I was gonna say we got about a little bit less than 10 minutes to make sure we have plenty of time to get everything wrapped up too. But did have just a question on experience of the borrower. How much do you look at like number of deals versus like maybe the dollar amount that's been involved in the deals? Are you looking for, is it more important that people have done several deals even if they're smaller versus somebody who's only done one or two and they've just been larger in dollar value?
Every lender great question. I love the question. Every lender looks at it differently. I look for number of deals. I want to see repetition, because people can get lucky with one or two, larger deals. And typically they have mentors or sponsors themselves inside those deals. I want to see repetition. I want to see a clear ability to take multiple assets and get them off your book.
Okay, thanks. Yeah, so we got about a little less than 10 minutes or so. I'll let you kind of continue through, and anyone has questions, throw them in there. We'll try to have some time at the end for those.
Yeah, so I'm actually finishing up. This is actually the last slide of lending, actually. And the last thing I'll make real quick before I wrap up here is I look for community affiliation. Now, this is like a very subjective sort of thing, which I'm allowed to do. A bank may not be able to do the same thing, but I like, community affiliated people. So, and I look for their spot in the community, because I think there's something about saving face, and I think there's something about some of the community norms that influence your character. And I lend heavily to military affiliated people, actually. I used to be in the Army. I know a lot of Army people. And that's just where a lot of our borrowers come from. And I'm well known in those spaces. And everybody knows everybody inside that particular community because it is somewhat small. And we're lending outside military bases, actually, as far as Trophy Point is concerned. So I care a lot about what community you come from. So anyway, that wraps up like lending and stuff like that. There's one slide I just wanted to show you. And this is what Trophy Point does right now as of the end of February. We're in a lot of states. The red dots are our active loans and the blue dots are our current loans. Sorry, the red dots are active loans and the blue dots are all of our paid off loans. So, we have a strong history, and Georgia and Texas, like I said, are our largest states, probably because that's where the most military bases are in the first place. So that's it for me, actually. I'm open for questions. Like I said, feel free to contact me anytime. We love our IRA investors. We give higher rates of return, actually, to people that invest via self-directed IRAs. You don't have to pick Advanta as your custodian, obviously, but we highly recommend them, because if you're a first timer to this game, the transition to go from selling your stock in a Fidelity account over to a self-directed IRA or into a custodian can be somewhat daunting. And we like Advanta because you can pick up the phone and call somebody, whereas others, the larger groups out there, you're just on a chat or you're on an automated sort of function, or you can only do customer service via email, which I don't particularly like, and I don't think our investors do either. So.
Yep. All right. Well, Samir, we had a couple questions pop in here right at the end, so I'll get to a couple of these. Someone asked, "What is your fund interest rate?" I don't know if that's maybe the interest rate you're paying your people, or the rate you typically lend at.
Yeah. So we're a debenture fund, so we give our investors 8, 10, and 12% depending on how much money they put into the fund, and it's a bond-like instrument. So you get a guarantee basically of the assets of the fund. You have an actual legal claim to the assets of the fund as a bond-like instrument. And you know what you're going to get every quarter. It's very, very predictable. And you have my first loss on top of that, meaning I'll lose all my money before you lose any principal. That's the way we do it. And then when we lend out, we typically, as of today, we lend out at 11 to 12%, 13%, and 2 to 4 points. and there's a spread to be made, and I get to keep the spread for myself. But then again, I also have my first loss in there. Um, and if you're a borrower, the points and interest is always negotiable. Like if you're going to put a lot of money down, our minimum is 10% down. But if you're willing to put 20% down, then the rates and the fees come down dramatically.
Okay. The question said, talk about investing in the fund. They said, if somebody were to invest with you, do they pick a single property to invest in, or are they contributing kind of to the general fund itself? Which I know the answer. I'll let you answer. But are there minimums, and also do you have to be accredited investors to be able to invest in your fund?
Yeah, great questions. I'll answer all in one sentence. Yes, accredited. Minimum is $25,000, and your dollar is pooled, meaning that you're tied to not just one loan, you're tied to the prospects of the entire portfolio. And there are two types of lenders out there. You can go with a private lender that ties your money directly to one deal. That's a lot riskier, obviously, because it's just one deal that could make or break you. We're a pooled fund, so your dollar in Trophy Point, if you invest in Trophy Point, is tied across the 338 loans at least as of February. We're about 330 right now. Your dollars are tied across all of the loans.
Someone says, can you invest only through Advanta? The answer is no. I think, yes, you can use your IRA through us, or you could, if you have an IRA out there, you could use our services to invest that way. But you can also invest personally, correct, Samir? You mentioned already you can invest, with either through another custodian if you really want to, or if you have personal funds. So
yeah, exactly. I'll do this. Yes, we have standard investments. So like, you can invest through your LLC. You can invest, through any private vehicle that you set up. You and a group of friends could invest if you wanted to through an LLC, or you can just invest as John Smith, or you can go through an IRA, but you got to do through a custodian.
Yep. Last question we have up here right now, maybe we'll cut it off after this, but someone said, when you borrow money, so I don't know, in situations maybe where some of you have personally borrowed money, what is the minimum and maximum you want to borrow? And what are the rates or terms? So it maybe you already answered that a little bit with kind of saying what your fund does, but is there a minimum kind of loan to value ratio you guys use, or a max, I guess, for that matter too?
Yeah, in our case, the max LTV ratio matters more because I want to lend with a hefty safety margin, ideally. So like 70% is, what we lend on. Now, that LTV, that value can be defined in actually a number of ways. We lend 70% on the future value of the deal, right? So it may be worth 100K today, but with the rehab dollars, it may be worth, 200 tomorrow. We will lend on the 200, but that doesn't mean we're going to release all the money at the same time. We will release money in chunks as you progress through the project. And that's known as draw reimbursement construction draws. And I'm happy to, if you want to borrow money, I'm happy to like explain that later. But we will lend the overall amount based on the future value, but we lend the cash in tranches as you progress through the deal as well. And our minimum loan is like 50,000, and our maximum loan is probably no more than 3 million.
Okay. All right, well, Stuart, thank you again for joining us today. Another great webinar. We've had you on in the past before, probably have you on again as well. Really appreciate the information that you share when it comes to the private lending, kind of sharing a different way that people can invest. Like you said, there's certainly ways, if you have money, IRAs or personal, where you'd be able to go on an individual basis and just kind of do a one-off deal with a friend on their property or another investor. But this is another way to do it if you don't want to go out and try to find your own deals or have to evaluate your own deals and have somebody else kind of do it for you. That's why we wanted to ask Samir, come on, just show a different avenue for private lending. So Samir, again, thank you again for coming on today and sharing that with us. Yeah. Here's Samir's contact information again, if you want to reach out to him with any additional questions that you have. If you're looking to get started with the IRA, it's very simple. It's filling out paperwork with us to get the account opened, get it funded. Usually takes about a week or two, depending on whether your funds are originating from. But it's a very simple process. We walk you through it, getting the account started, and ultimately getting your investment made. If you're doing a private loan or investing into a private fund, there's always going to be paperwork or documents that need to be done in the name of the IRA, and that's what we're going to make sure that we put out there as well. Somebody asked me to pop up Samir's information again. I'll just put that here for for that borrower or for that attendee here for the next few minutes. But Samir, any closing thoughts you want to have before we wrap up?
I think the thing I'll always leave you with, like, investing is a long game, and your compounding rate matters a lot, over time. Now, I imagine maybe the audience may be on the little older side, but not losing money in real estate is the most important thing you could do, from my opinion, versus trying to hit home runs. And so when you hear, pitches from syndicators that are trying to pitch you into a multifamily deal, and you're thinking about using your IRA dollars, just know that the syndications, especially in the multifamily side, are fraught with a lot of risk because those guys are taking on a lot of leverage. I think for IRA dollars, you want to be the lender where you have a whole lot more security and a greater chance of hitting compounding goals versus trying to hit home runs. So that's all I'll say. And you can do it through me, you can do it through private lending, but I think you can, there's so many avenues to achieve that without taking on undue risk.
All right, Samir, again, thanks a lot for coming on again today. Here's my contact information. If you have questions on the self-directed IRA, always happy to jump on a call, jump on a Zoom, answer your questions about what we talked about today, maybe something else that popped up that you wanted a one-on-one question for. Again, appreciate everyone for logging in today and spending some time with us. If you are listening to the recorded version of this webinar, certainly reach out to myself or Samir with your questions. We'll be happy to get those answered to you. So again, Samir, thanks again for your time today.
Of course. Thank you, Scott. Really appreciate it.
All right. Thanks, everyone, for attending, and we'll see you next time.
Bye.